I made $100 million in a single day when Wall Street crashed in 1929. While bankers were jumping from windows, I was calmly collecting my profits, the result of preparation, not luck. In the next 40 minutes, I'll show you exactly how I saw the crash coming months before anyone else, and how you can apply these same principles to protect and multiply your capital in any market condition. The secret isn't complicated. It's about understanding that markets never change. Human psychology remains constant across centuries. Fear, greed, hope, and ignorance drive prices in predictable patterns that repeat themselves with mathematical precision. I discovered this truth through painful losses and spectacular victories across 4 decades of trading. In 1929, I observed something critical. Stocks had risen too far, too fast. The public was intoxicated with dreams of endless prosperity. Taxi drivers and shoeshine boys gave stock tips. The financial pages read like romance novels. These were the same signals I'd seen before previous crashes. The market was speaking to me through price and volume, telling me disaster was imminent. I began building my short position methodically, adding to it as prices climbed higher. When the crash finally came on Black Thursday, I was positioned perfectly. While others lost everything, I harvested millions. Not because I was smarter, because I respected market principles that never change. By the end of our time together, you'll understand my core trading principles that generated millions across bull and bear markets alike. You'll learn how to read the market's true intentions, not through tips or news, but through price action and volume. You'll discover why most traders fail, repeatedly making the same psychological errors that transferred their money directly into my accounts. I'll show you how I developed ironclad discipline after losing my fortune 3 separate times, how I learned to cut losses ruthlessly and let profits run, why I traded only with the prevailing trend, never against it, and most importantly, how I developed the courage to act decisively when opportunity presented itself. These principles aren't theoretical. They're battle-tested through the most violent market swings in history. I've applied them to make millions in commodities, stocks, and currencies. They work because they're based on unchanging market truths, not fashionable strategies that come and go. I don't care if you believe me. The market doesn't care about beliefs. It only respects correct action. Pay attention to what I'm about to share, and you'll gain the understanding that took me decades and millions in losses to acquire. My first painful lesson came at 14, when I bet my entire $3.12 on Burlington stock. I'd been tracking patterns on a chalkboard at the brokerage house after dropping out of school. The numbers told me Burlington would rise, and it did. I doubled my money to $6, feeling invincible. The classic beginner's trap. Pain teaches what books cannot. After that initial win, I kept betting, believing I'd found some magical formula. I hadn't. The market humbled me repeatedly, taking my money and my pride. By 16, working as a quotation board boy in Boston, I'd already experienced more financial pain than most traders face in their first decade. I developed my system through suffering. Every loss taught me something the previous one couldn't. When I lost $1,000, a fortune for a teenager in the 1890s, I didn't sleep for days. But that sleeplessness forced me to analyze where I went wrong. The pattern became clear. I was trading on hope, not mathematics. My early bucket shops, gambling dens disguised as brokerages, banned me for winning too consistently. They couldn't understand how a kid had figured out their rigged game. What they didn't realize was that each time they'd taken my money before, they'd given me something far more valuable: data. Each loss was a data point in my evolving system. By 21, I turned $500 into $10,000, lost it, made $25,000, lost that too. These weren't just financial setbacks. They were necessary calibrations. The market was teaching me emotional discipline. When I'd get overconfident, it would take my money. When I'd get desperate, it would take even more. I still remember the crushing feeling of bankruptcy. Not once, but multiple times. Each time I'd climb back, having learned something new about the market, and more importantly, about myself. The pain of losing everything forces a clarity that winning never provides. My advice to you: don't run from pain. Extract its lessons. When a trade goes against you, don't just close it and move on. Dissect it. What did you miss? What emotion clouded your judgment? The market speaks through your losses more clearly than through your wins. I didn't become the boy plunger by avoiding mistakes. I became successful by paying attention to what those mistakes were teaching me. Your trading education will cost exactly what the market decides it should cost. The only question is whether you'll learn from each tuition payment. The anatomy of a signal isn't complicated, but it requires patience and discipline that most traders simply don't possess. When I analyze the market, I'm looking for specific confluences that align like planets in a rare celestial event. Let me show you exactly how I identify these moments. First, I track price pivots, those critical turning points where the market reveals its true intentions. I don't just look at daily charts. I study multiple time frames simultaneously. When a stock makes a series of higher lows during a broader market downtrend, that's when my attention sharpens. This divergence speaks volumes if you know how to listen. Second, I watch volume patterns religiously. Volume is the fuel that powers price movement. In 1907, before the panic, I noticed trading volume in Union Pacific declining on rallies while increasing during sell-offs. This told me the smart money was distributing shares to the public. I sold short and made millions when the crash came. Volume never lies. It's the footprints of money. Third, I pay attention to sector rotation. Markets move in harmony, but not simultaneously. In 1929, I noticed utilities weakening first, then rails, then industrials. This sequential breakdown was my warning sign. By understanding these sector relationships, I positioned myself correctly before the great crash. Fourth, I monitor market leaders. Every significant market move has its generals leading the charge. When these stocks begin to falter while the broader market continues upward, it's like watching the foundation crack beneath a seemingly solid structure. Finally, I wait for confirmation. Patience separates the amateur from the professional. I don't act on the first hint of a signal. I wait until multiple indicators align. This patience cost me opportunities, yes, but saved me from countless disasters. My system isn't about predicting the future. It's about recognizing patterns that have repeated throughout market history. The market telegraphs its intentions if you develop the sensitivity to feel these subtle shifts. Remember this: the signal isn't just technical, it's psychological. When I sense excessive optimism while my indicators show weakness, that's when I prepare to act against the crowd. This contradiction between public sentiment and market reality creates the most profitable opportunities I've ever found. Mastering the anatomy of a signal took me decades and cost me several fortunes before I truly understood it. You must study the market's language until it speaks to you as clearly as I'm speaking to you now. I made my fortune 3 times over, and I lost it just as many times. My most painful losses came when I betrayed myself, when I ignored my own trading rules that had made me millions. In 1929, I made 100 million shorting the market during the crash, but by 1934 I'd lost it all. Why? Because I abandoned my own system. Let me tell you about the most expensive lesson I ever learned. After my tremendous success shorting the 1929 crash, I grew overconfident. I began to think I was infallible. This is a deadly sin in the market. I started taking positions based on tips, rumors, and what other people thought. Precisely what I'd warned against my entire career. I had a rule: never act on tips. Yet there I was, taking advice from people who hadn't earned a fraction of what I had. I violated my own principle of patience. Instead of waiting for the right setup, I forced trades out of boredom or greed. I ignored my own rule about cutting losses quickly. When positions moved against me, I doubled down instead of getting out. The market doesn't forgive self-betrayal. By 1934, nearly everything I had built was gone. I had to start over at 57 years old. The psychological toll was devastating. I'd built my reputation on discipline and system, yet I'd abandoned both. This pattern of self-sabotage isn't unique to me. I've watched countless traders develop solid systems, achieve success, then abandon those very systems that brought them wealth. The moment you think you're smarter than your proven methodology is the moment you begin to fail. I documented this pattern in my trading journal. The market taught me a $100 million lesson for abandoning my own rules. I had to face the humiliation of bankruptcy, not because my system failed, but because I failed my system. The markets don't care about your past successes. They don't care about your reputation or your ego. They simply respond to supply and demand, action and reaction. When you ignore your proven methodology, you're not operating in reality anymore. You're operating in fantasy. Remember this: your trading rules aren't arbitrary. They're battle-tested boundaries that protect your capital. They're the distillation of painful lessons and hard-won insights. When you violate them, you're not being flexible, you're being foolish. I paid the ultimate price for this lesson. Don't make my mistake. Honor your system, especially when it's difficult. The moment you're most tempted to break your rules is precisely when you most need to follow them. Patience is a weapon most traders never learn to wield properly. In 1907, when Wall Street was gripped by panic, I made one of my greatest fortunes not by frantically trading, but by waiting. The Knickerbocker Trust Company had just collapsed, triggering what we now call the Panic of 1907. The market was in free fall, and most traders were desperately selling everything or trying to catch falling knives. I sat in my office watching the ticker tape, completely still. My brokers thought I'd lost my nerve. They didn't understand that I was exercising the most powerful trading muscle, patience. I waited 3 full days while others scrambled. I observed the patterns, the volume, the behavior of certain stocks under pressure. Only when I saw the specific signals I was looking for did I begin shorting the market aggressively. That patience netted me nearly $3 million, about $86 million in today's money. Not from brilliance, but from the psychological discipline to wait until the odds were overwhelmingly in my favor. The psychology of patience isn't passive, it's intensely active. Your mind is working, analyzing, preparing, but your hands remain still. This is where most traders fail. They confuse action with progress, movement with effectiveness. I've learned that waiting for the right moment is often more profitable than 100 small trades. When I teach traders my methods, the first question is always about entries and exits. But the most important skill is what happens between trades, the discipline to do nothing when nothing is the right thing to do. The market doesn't reward activity, It rewards correct activity. I developed a specific mental framework during that 1907 crisis. First, I identify the primary trend. Then, I wait for a significant move against that trend, what most would call a correction. Only then do I look for my specific entry signals. If they don't appear, I continue waiting, sometimes for weeks. This approach requires you to overcome 3 psychological barriers: the fear of missing out, the need for constant action, and the anxiety of holding positions. I conquered these by developing rules that removed emotion from my decisions. Remember, the market will test your patience more than any other quality. It will tempt you with seemingly obvious opportunities. It will bore you into making mistakes. It will pressure you when prices move rapidly. The true test comes when everyone around you is trading frantically while you remain still, waiting for your moment. That moment came for me in 1907, and it changed my life forever. Master this psychology of patience, and you'll have an advantage few traders ever develop. The market gave me the most expensive lesson of my career in 1915. I'd accumulated over $5 million through careful trading, equivalent to over $130 million today. Yet I lost nearly everything in a single catastrophic failure of judgment. Not because my market analysis was wrong, but because I violated my own trading rules. I'd developed a bearish position on cotton, shorting the market heavily. My analysis was sound. Fundamentals pointed to declining prices. But I made a fatal error that I want you to avoid at all costs. I ignored my own stop-loss rules because of overconfidence. When cotton prices unexpectedly rose against my position, I should have immediately covered my shorts and accepted a small loss. Instead, I doubled down, convinced the market would eventually prove me right. I kept averaging up, throwing good money after bad. This is precisely what I'd warned others never to do. The cardinal rule I violated: never average a losing position. The market doesn't forgive arrogance. By the time I finally admitted my mistake, I'd lost nearly my entire fortune. I had to declare bankruptcy, my second one. The humiliation was crushing, but the lesson was invaluable. Here's what this costly mistake taught me. No trader, regardless of past success, is immune to market forces. The moment you believe you're smarter than the market is the moment you're most vulnerable. From this disaster, I formalized 3 principles that saved me from future catastrophes. First, never ignore your predetermined exit points. When the market moves against your position beyond your stop-loss, exit immediately, no exceptions. Second, never average down on a losing position. This is how small losses transform into account-destroying disasters. Third, admit mistakes quickly. The market doesn't care about your ego or reputation. Pride is the most expensive luxury in trading. I eventually rebuilt my fortune by following these principles with religious discipline. My 1915 disaster became the foundation for my greatest period of trading success that followed. Remember this: the market will repeatedly test your discipline. It will tempt you to break your rules just this once. But that one exception is all it takes to destroy years of careful work. The truly great traders aren't those who never make mistakes. They're those who survive their mistakes and learn from them. I paid $5 million for this lesson. You can have it for free. After years of refining my approach, I finally codified my signal system in Boston during 1923. This wasn't just another trading methodology. It was the culmination of everything I had learned through devastating losses and spectacular gains. The market had taught me its language, and I had finally learned to listen properly. My signal system revolves around one fundamental truth: price tells all. While others were obsessing over earnings reports, insider gossip, and economic forecasts, I focused exclusively on price action. When a stock breaks through resistance after multiple attempts, it's telling you something profound about the underlying buying pressure. The genius of my system lies in its simplicity. I look for stocks making new highs after consolidation periods. When a stock makes a new high, particularly on increased volume, it's signaling the beginning of a potential major move. I don't try to buy at the bottom or sell at the top. That's a fool's errand. Instead, I wait for confirmation from the market itself. Let me be clear about what makes this system work: patience and discipline. In 1923, I watched United States Steel for nearly 3 months before entering a position. The stock had been trading sideways, but my system detected subtle changes in its behavior, slightly higher lows, testing resistance with increasing frequency. When it finally broke out, I committed substantial capital and rode it for a 30% gain. The most powerful signals come when multiple time frames align. I look for daily, weekly, and monthly charts to confirm the same directional bias. When I see this rare alignment, I increase my position size significantly. This precise approach allowed me to accumulate over $3 million during 1923-1924, a period when most traders found the market challenging. My signal system also incorporates market context. I never fight the general market trend. If my signals suggest buying a stock, but the broader market is clearly in a downtrend, I wait. The strongest signals emerge when individual stock action aligns with the market's direction. The beauty of this system is its adaptability. Whether trading cotton futures in 1907 or railroad stocks in 1923, the principles remained consistent. Price action, volume confirmation, and trend alignment form the foundation. Everything else is noise designed to separate you from your money. Remember this: the market will tell you what it's going to do if you develop the discipline to listen. My signal system isn't about predicting, it's about responding to what's actually happening, not what you think might happen. October 1929, the ultimate vindication of everything I'd been warning about for months. I'd been heavily short since September 3rd when the market peaked, and as I watched the collapse unfold, I felt no joy, only the cold satisfaction of having read the signals correctly. I'd seen the warning signs that summer: excessive margin lending, wild speculation in radio stocks, and taxi drivers giving stock tips. The smart money, the real professionals, had already quietly exited. But the public kept buying, believing the fantasy that stocks only move in one direction. On Black Thursday, October 24th, the market opened down sharply. I watched from my office as panic spread across Wall Street. Brokers couldn't find buyers at any price. The ticker tape ran hours behind actual trades. Complete chaos. When stocks briefly rallied after bankers attempted to stabilize the market, I doubled my short position. I knew this was just the beginning. By Black Tuesday, October 29th, the collapse was complete. I made approximately $100 million in today's dollars during that crash, my greatest single trade. Not because I was lucky, but because I followed my rules with iron discipline. Here's what I want you to understand about market crashes. They don't appear out of nowhere. They give warnings, if you're willing to see them. In the months before October 1929, I observed declining market breadth, fewer stocks participating in rallies. Volume patterns changed. The leaders that had driven the bull market began to falter. The smart money was distributing shares to the public. I didn't need inside information. I didn't need to know why. I simply observed the market's behavior changing and positioned myself accordingly. The 1929 crash taught me the ultimate lesson in conviction. When you know you're right, size your position appropriately. Small positions with strong conviction produce small results. I went all in because my analysis showed overwhelming evidence of what was coming. Remember this: markets can remain irrational longer than most can remain solvent. I waited patiently for months while others mocked my bearish stance. I endured ridicule from the financial press. I watched friends lose fortunes buying dips. But markets eventually return to reality, and when they do, the move is swift and merciless. The greatest opportunities come when you stand against the crowd with absolute conviction. October 1929 wasn't luck. It was the culmination of years studying market behavior and the courage to act decisively when others froze in fear. The 1929 crash wasn't luck for me. It was the culmination of pattern recognition I'd spent decades perfecting. I watched the market reach unsustainable heights throughout 1928 and early 1929. While newspapers trumpeted endless prosperity and shoe-shine boys gave stock tips, I sensed the familiar rhythm of an overheated market ready to collapse. The signs were there for anyone willing to look beyond the hysteria. By September 1929, I had liquidated my long positions and established a massive short position worth over $3 million, equivalent to about $50 million today. This wasn't gambling. This was mathematical certainty based on my trading rules. The market had reached a state of pure speculation divorced from economic reality. My waiting game began. For weeks, I endured criticism. Friends called me paranoid. Financial columnists mocked my bearish stance. My own brokers questioned my judgment as the market continued climbing. But I'd seen this movie before in 1907 and 1921. The higher it climbed, the harder it would fall. Patience is the rarest commodity in trading. Most traders cannot tolerate the psychological pressure of waiting. They need constant action, constant validation. I've learned to embrace stillness. While others frantically traded, I sat quietly with my position, watching for confirmation. When Black Thursday hit on October 24, 1929, the Dow plunged 11% at the opening bell. Many thought this was the bottom and rushed to buy the dip. I knew better. This was merely the first tremor. I held my shorts through the panic, through the temporary recovery, through the desperate reassurances from bankers and politicians. By Black Tuesday, October 29th, the market completely collapsed. As the Dow fell 12% in a single day, my short positions exploded in value. I walked away with over $100 million in today's dollars, one of the greatest single trades in market history. The lesson wasn't about predicting the crash. It was about pattern recognition and the discipline to act on it despite overwhelming social pressure. The market always moves in patterns, and excessive speculation always ends the same way. Always, most importantly, I had the patience to wait for the market to prove me right. I didn't need immediate gratification. I could tolerate being temporarily wrong because I trusted my analysis. This psychological fortitude, the ability to stand apart from the crowd, is what separates legendary traders from everyone else. Remember, the crowd is usually wrong at market extremes. When everyone agrees on the market's direction, prepare for the opposite. That's not cynicism, it's mathematics. Tahor became my greatest cautionary tale. After decades of disciplined trading, I abandoned my own rules and deviated from the very system that had made me millions. I had spent years perfecting a methodology based on patience and precision, waiting for the ideal setup, confirming market direction, and executing with conviction. But human nature is a powerful adversary. even for those who believe they've conquered it. I began making impulsive trades based on tips and hunches rather than my proven analysis. The cotton market particularly drew my attention that year. Despite all my experience telling me to wait for confirmation, I jumped in prematurely, convinced I could anticipate the move before my indicators confirmed it. This was pure arrogance, the deadliest sin in trading. When you've had success, you begin to believe you're special, that the rules don't apply to you anymore. I fell into this trap after my earlier victories. I stopped journaling my trades meticulously. I stopped reviewing my mistakes. I believed I could bypass my own methodology and still succeed. The market punished me severely for this hubris. These impulsive trades cost me millions, but more importantly, they violated everything I knew to be true about successful speculation. I had taught others never to deviate from their proven system, yet here I was, doing exactly that. What makes this deviation so instructive is how it demonstrates the psychological deterioration that happens when you abandon discipline. First came overconfidence from past success. Then came the belief I could feel the market rather than read it objectively. Finally came rationalization, explaining away losses as temporary setbacks rather than symptoms of a broken approach. My impulse trades of 1934 weren't random errors. They were systematic violations of everything I had learned. I ignored position sizing, abandoned my timing methodology, and traded without confirmation. I even began averaging down on losing positions, a cardinal sin I had warned against countless times. The lesson is clear. No trader, regardless of past success, is immune to psychological deterioration. Your methodology is your lifeline in the markets. Once you start making exceptions, you've already begun the process of failure. Had I simply followed my own rules, waiting for the proper setup, confirming the trend, and sizing positions appropriately, I would have preserved my capital and lived to trade another day. Instead, I let impulse override discipline and paid the ultimate price. Remember this: the moment you believe you've mastered the market is precisely when you're most vulnerable to its punishment. My signal system wasn't some complex algorithm. It was built on pure price action and market psychology. When I developed it in the early 1900s, I had no computers, no algorithms, just my observation skills and a deep understanding of how markets breathe. The foundation of my system was what I called pivotal points. These weren't arbitrary support and resistance levels that amateurs draw on charts. My pivotal points represented genuine psychological barriers where the market's character would change. When a stock penetrated these points with conviction, I knew a significant move was underway. Let me explain exactly how I identified these signals. First, I tracked stocks making new highs or lows after periods of consolidation. This wasn't about buying breakouts blindly. I waited for confirmation. If a stock made a new high and held above that level for 3 consecutive days, that was my entry signal. The market was telling me something important. For short positions, I applied the same principle in reverse. When a stock broke down below significant support and remained there for 3 days, I'd establish my short position. The 3-day rule wasn't arbitrary. It filtered out false moves and confirmed genuine trend changes. Volume was my secondary confirmation. Price movement without volume is suspect. I wanted to see expanding volume on breakouts, evidence of institutional participation. When Union Pacific broke through $165 in 1906 on triple its average volume, I knew the move was legitimate and took a substantial position. Most traders overcomplicate their systems with endless indicators. My signal system focused on one thing, the line of least resistance. When a stock moves through a pivotal point, it reveals the path of least resistance. My job was simply to follow that path until the market told me otherwise. The beauty of my system was its simplicity. I didn't need to know why a stock was moving, only that it was moving with conviction. When U.S. Steel broke through $58 in 1907 on heavy volume, I didn't question the fundamentals. I simply rode the trend until my trailing stop was hit. Timing was everything. I never bought at the exact bottom or sold at the exact top. I waited for confirmation that the trend had changed. This patience saved me from countless false moves and premature entries that destroy most traders' accounts. Remember this: the market will tell you everything you need to know if you're willing to listen. My signal system wasn't about predicting the future. It was about recognizing when the future had already revealed itself through price action. The signal discipline I developed over decades remains the cornerstone of successful trading. I learned this through devastating losses. The market teaches its harshest lessons through pain. My signal system isn't complicated, but it demands unwavering discipline. The modern trader has advantages I never had: technology, instant data, sophisticated charting. Yet the fundamental principles remain unchanged. I always waited for confirmation before entering a position. This patience saved me millions. Today, you can implement my signal discipline by establishing clear entry and exit rules before placing any trade. When I traded cotton in 1907, I would wait until price action confirmed my thesis before committing capital. The same principle applies to your trading in any market. My pivotal rule was simple: never act on tips or hunches. The market will tell you what to do if you listen carefully enough. I developed a system of pivot points, price levels, that, when broken, signaled a significant move was underway. You can adapt this by identifying key support and resistance levels in your time frame and waiting for decisive breaks. I lost my fortune multiple times by abandoning my own rules. In 1908, I ignored my signals because I believed I knew better than the market. That arrogance cost me everything. Your trading plan must be sacrosanct. Once established, follow it religiously or pay the price. The most valuable implementation of my legacy is psychological. I learned to trade without hope or fear. Hope is the trader's worst enemy. It keeps you in losing positions. Fear prevents you from taking profits when you should. I trained myself to act mechanically on signals alone. This emotional discipline is what separated me from other speculators. Modern traders can implement my signal discipline through systematic trading plans. Define your triggers precisely. When price closes above the 50-day moving average, while volume increases by 30%, I enter. Then execute without hesitation when those conditions are met. I discovered that the market moves in recognizable patterns. These patterns repeat because human psychology never changes. Fear and greed drive markets now, just as they did in my day. By studying price action and volume, you can identify these patterns before most others. The ultimate implementation of my legacy is this: trade with the primary trend. I made my greatest fortunes by identifying major market movements and riding them patiently. The big money isn't in the buying and selling, but in the waiting. Implement this patience in your trading, and you'll avoid the pitfalls that destroy most speculators.